Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq, coming to you live from Exchange in Miami. Joining me for this segment, we have Tim Huver, Managing Director of the ETFs Team at Brothers Harriman. We're here to discuss market entry, product structure, T+1 and securities lending, all the good infrastructure stuff. Tim, it's great to have you with us.
Thanks
Welcome to TradeTalks.
Jill.
You got it. Let's talk about this T+1.
Yes.
Big deal in the industry. How is that going to impact ETFs?
Yeah, scheduled to launch in May. When we look at, I think it's important to note from the top that we are currently, and many providers within the industry, able to support a T+1 settlement today for ETFs, so it's not new or unique in some respects. The only difference is that it goes from being an exception today to the norm. And so when you think about how ETFs are created and redeemed, the delivery of securities in exchange for the ETF, for a US domiciled ETF with US equities on T+1, where those settlement cycles match, we expect very little friction. I think it's when you move into international markets and there's that mismatch where you may have to change the operating model to account for that, to protect the fund and ensure delivery of securities, whether through collateral or a change in maybe cutoff times or the settlement cycle. So that's where I think you'll see a lot of the work being done, and maybe even a movement to T+0 in the future. So I think what end investors want to know is, will this impact the trading of ETFs? Will my experience be different from a cost perspective in the future? And I think we're confident that although there may be an adjustment period, that investors won't feel this in terms of a material impact in the trading costs in the majority of products for the majority of investors.
The growth in the ETF space has been remarkable. So when you think about ETF market entry, product structuring, now we have mutual funds converting to ETFs, and even multi-share class is a big part of the conversation now. How are you thinking about that in terms of entering the market and structuring products to keep up with the competitiveness?
Yeah, so we're talking to asset managers, looking at the ETF space, obviously the adoption, the accelerated growth, the ETF as a wrapper being a product preference for many channels, and so asset managers looking at packaging their strategies. Traditionally, you would see a standalone ETF launched, separate and distinct from SMAs, from mutual funds. But what we're seeing now is that more and more asset managers looking at other options of entering the ETF space to leverage the scale, the track record that they may have in terms of performance, that really helps with distribution and with access to platforms. And so you have really two options there, a conversion of an existing SMA or a mutual fund to an ETF that can be done in a tax efficient way, and then also a multi-share class structure, which not yet approved by the SEC. We've seen a number of filings. We expect that the SEC will be cautious in terms of their assessment of those structures. So really, to date, it has been in terms of leveraging that existing scale and track record through the conversion route. And we've seen 32 sponsors convert over 70 funds and 70 billion in assets under management. So we expect that to continue going forward.
How or why are managers increasingly turning to securities lending as a core piece of their investment programs?
So we do see the largest asset managers and ETF issuers finding value with securities lending and embracing a securities lending program. And so when we think about every basis point mattering within the ETF space today, securities lending is really a way to take the holdings within the ETF that sit idle within the portfolio to lend those out for revenue, for income that's credited back to the fund. So improves performance. It's a way of just adding additional basis points in terms of the performance to end investors, which when you think about for many ETFs now in that single digit expense ratio, you can almost see it as a way to even offset the expense ratio. So I think the other key point here is that it can be done in a very risk-controlled way. Usually we find the demand for securities lending in a select number of names, and so you don't have to lend out a large percentage of the portfolio. It's very concentrated. You can take in high-quality collateral or cash. You don't have to stretch on reinvestment, and so in a very risk-controlled way, you can add incremental revenue for end investors and performance to the ETF.
Let's talk about some of the key themes at Exchange. Of course, one of the largest ones being the rise and growth of active ETFs,
yes.
Right? So do you expect that trend to continue, and why do you think there's been this explosion of growth in the active space?
I think when you look at the mutual fund space, it's no surprise here, but net outflows over the past 2 years is what we've seen, and we're seeing more of a product preference towards the ETF as a wrapper, and many of the asset managers or new ETF issuers looking at the ETF as almost a product agnostic approach to their product ranges, where they may offer mutual fund, SMA, and ETFs as well. And so for those reasons, the tax efficiency that ETFs provide over mutual funds, I think we'll see more and more active managers enter the space. Only 5% of the AUM are in active strategies today, but when you look at the cash flow last year, over 20% of the cash flow in the US were into actively managed ETFs. So we expect that, we're now seeing investors starting to vote with their dollars, and we expect that demand to continue and more products in that space.
This might be an elementary question, but does it change for the portfolio manager how they do stock selection or run their screens, whether it's in a mutual fund or an ETF? Does the actual investment process change at all?
It looks, I think, in terms of just how active managers are viewing their strategy, I think first and foremost, you want to make sure that you're thinking about, with an ETF, unique considerations such as capacity. So you can't shut off an ETF to new cash flow as you could a mutual fund if that strategy starts to reach capacity. So that would be one. And then also transparency, and there are a few models as to whether or not you want to present your entire portfolio each day. There's a semi-transparent model, and we're seeing more and more, I think, managers become comfortable with a fully transparent portfolio as well. But I think with the ETF, because that in-kind redemption and creation activity being the mechanism for trading, you do have to think about how you structure those daily baskets in order to accommodate, and on what frequency, accommodate that trading that may happen in cash within the mutual fund. So slightly different, I think, in terms of the structuring, but those would be the key considerations for ETFs.
And of course, we're always talking about innovation in ETFs and new products and so forth. When you think about go-to-market strategies for new entrants in the ETF space, is there room for newer entrants within the industry? Certainly, and there are spaces within the market that I think are emerging as segments where we're seeing more product demand, we're seeing more managers enter those particular categories. I will say that ETFs, though, if you launch the ETF, if you build it, they won't just necessarily automatically come. And right.
So there's, ETFs are sold and not bought in many instances. You need that distribution presence in terms of the structuring of that ETF team and the specialists, and there are unique variables to ETFs that need to be accounted for within that distribution process, so that becomes very important. And then I think what we're also seeing is technology and digital becoming more and more a part of the sales process, really understanding who's engaging with your content, understanding that 360-degree view of advisors, being very personalized, customized in terms of your efforts when engaging with advisors. And so that's becoming increasingly important as the space becomes more crowded and looking to differentiate through distribution.
All right, Tim, appreciate the insight. Thanks
Jill,
for joining
thank
us
you
on
so much.
TradeTalks. You got it.
Great.
Thanks for joining me from Exchange. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.